Hey everyone, in this video, I'm going to bring you one dividend stock that's down 50% off the high that I think you can buy hand over fist in 2024. So let's get right into it. Let's look at what the dividend stock is and why I'm recommending it as a buy.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so the dividend stock that I'm talking about in this video is Macys. Macys is down 49.67% off its high as the company has struggled to adapt in the changing online spending environment. But there are reasons that Macys stock is extremely attractive, and I'm going to share those with you right now. So, as I mentioned, Macy's has struggled to adapt to changing consumer behavior, and revenue is declining from around 28 billion in 2015 on a trailing 12-month down to 24 billion most recently. Now, Macy's has been shrinking and transitioning. So, shrinking its footprint in brick and mortar locations, not having as many locations, and then changing the type of locations, doing more of their lower priced Macy's locations where people can find bargain priced items versus its more premium priced stores in the Macy's and Bloomingdale's version. So it is changing, trying to adapt to consumer behavior, although it's doing so slowly. Macy's does offer dividend stock investors a dividend yield of 3.52%, a solid dividend yield. There are companies with a better dividend yield, but Macy's dividend yield is, I think, sustainable, but also I think there's more to Macy's stock than the dividend yield. I think passive income investors have a chance to experience a strong capital gains return from Macy's to supplement this dividend return. Along with Macy's declining revenue, it's also been experiencing falling profitability. Its operating profit margin declining to 4.16%. Although I will highlight that management made several improvements when it had to lock down or shut down many of its stores during the early stages of the pandemic. And those improvements, I think, are going to pay off longer term. One of those was to reduce the number of corporate office locations. It had two. It now consolidated into one location. So now that fewer costs in the areas that I'm most in favor of. Corporate costs are one of my least favorite expenses for a company to have. I think there's a lot of waste there, a lot of redundancies, and so I was glad to see Macy's do that. Another strategy Macy's has done, which I think is going to pay off also, is allowing third parties to sell inventory on its website. So Macy's doesn't need to own all of the inventory that it sells, which has two benefits. Number one, the business becomes less risky because it doesn't need to invest in the inventory and risk buying inventory that doesn't sell, and then they need to discount the inventory and then sell it. Another is that now it makes more items available on the website, so consumers have more selection, increasing the odds that they find what they're looking for when they go to Macys.com. And so that could increase visitation, increase the number of purchasers that go to Macys.com. It also makes the website more valuable because it's attracting more visitors, which could fuel another trend that I like with online websites, and that is advertising. Companies like Walmart, eBay, Amazon have had tremendous success selling advertising because consumers are very close to make a purchase. And so marketers are eager to reach those consumers. You know, when somebody goes to Macys.com, they're looking to buy something. So as a business, as a marketer, you want to reach that consumer right at that moment before they're going to buy something and influence that purchasing decision. And so with this strategy, that makes that advertising more lucrative, and I think that's going to fuel and that's going to increase profitability longer term because advertising is a more lucrative source of revenue than what Macy's has been doing in the past. Similarly, its cash flow from operations have been moving in a downward direction to 5.37%. Not strong and not very good. So all of these things point to a declining business. So you might ask, why am I recommending Macys stock? In fact, I own Macys stock. I've owned Macys stock, I want to say for a few years now. I bought it near the lows in the pandemic. I think my cost average is about $5 or $6 a share or something like that. So I have some big gains in a Macys stock. The primary reason I like Macys stock and why I'm recommending it is valuation. Valuation. I think Macys stock is significantly undervalued. Let me share with you. So Macys market cap is about $5.155 billion right now. However, Macys owns many or hundreds of the locations that it operates inside. And that real estate is estimated to be worth more than $5 billion. So the real estate that Macys owns alone is worth more than what the entire market cap of the business is. So you're essentially getting Macys business for free because the real estate already is worth more than the market cap. Let me show you one estimate here. So Macys currently owns roughly 300 of its 783 stores. Okay. Macys real estate is estimated to be worth $8 billion, including $2 billion its Manhattan flagship location. And that's one reason why it received a $5.8 billion buyout offer from Arkhouse Management and Brigade Capital Management. They were interested in buying Macys at $21 per share in December. So that's what has investors attracted to Macys stock, is because it's so undervalued. It's so well positioned in terms of the value of the business compared to the value of the stock. Is trading at a forward price to earnings of just 6.956. So even if you're not talking about the value in the real estate, if you're just trying to compare the valuation to the earnings, you're getting it at a forward PE of 6.956, which is not expensive. It's a cheap valuation. And of course, there's a reason it's cheap, because the business is declining. It needs to shrink. It needs to have fewer locations and transition into smaller locations that target more bargain shoppers and less towards the premium shoppers. That's the direction consumer behavior is moving towards. But you get this two-sided potential for return with Macys. That's why I own it, and that's why I'm recommending Macys stock as an excellent dividend stock for passive income investors to buy. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.